This is very much in my personal capacity. The UN's still thinking about a lot of these issues, so I don't attribute anything to anyone but me. I'm going to just spread through a whole lot of issues, and a lot of it will revolve around the current discussions and the very helpful proposal by the OECD Secretariat, and it is a Secretariat proposal, not yet an inclusive framework, for example, proposal on some of the ways forward on digital, but also I think there's some wider implications. So, well, the first thing is tax is becoming increasingly multilateralised, and there are a few issues relating to that. You know, what is the future role of bilateral negotiations? And bilateral negotiations can be slow and painstaking and hard to change, but they also can take account of the differences of countries. For example, Ghana is very strong on seeking a fees for technical services provision, and they do that for a reason, and rightly or wrongly they have more chance to achieve that in a bilateral negotiation than more broadly, or may have. And another thing is, you know, I often wonder that there's a demonisation of unilateralism. So, you know, unless we get this done quickly, there'll be this terrible outbreak of digital services taxation. And, you know, I actually personally find that a little bit ironic, because if you look at the OECD work on BEPS, and this is not a criticism of it, but a lot of it is based on unilateral approaches, particularly the US and things like the UK patent box and so forth. And at least in theory, unilateral approaches can lead you forward. I would have thought, certainly you can say we should try to get as much harmony as possible in digital taxes if that's the way countries are going. But while in the UN we do believe that a multilateral approach, an effective multilateral approach, is more important than countries going their own way, you get a package deal that overall can be better for you, particularly developing countries. It really comes down to how good an exercise of multilateralism are we talking about, and I'll talk a little bit about that in a minute. So, the issue is what makes a good multilateral agreement, and there's a lot of really good academic studies on what makes a good academic agreement. I'll be talking in a minute about some of the aspects of that. And I think a lot of people have got caught up in the technical dimension of this, and then some people have got caught up on the political dimension. I was at a speech recently by Barbara Angus, very famous, the head of EY's, she's the global, essentially the policy head, and she was expressing concern that the political agreement was being sought before there was an open presentation, before the technical dimension had been more fully explored. And this is a typical a chicken and egg situation, as they say. To what extent do you need the political push to make something happen at the technical level? And I think the OECD is very aware you do need some political push. But then to what extent does the political push have to be founded on a recognition of the technical, the results of the technical possibilities and the implications for them? And I think we see this at the moment, now that we have the OECD work public. There's a push to get a political buy-in, but there's also a look at the technical levels and some of the issues like, you know, where is the residual? How high is the residual going to be? Is it going to be a tiny little space, or is it going to be a bigger space, and so forth, and all sorts of other very important issues. And this is a very important issues, including at the country level. To what extent can you advise your minister on what's available at the moment? To what extent need the minister to say, well, we need to know more about the different options, and we'll see what happens? It's a really important question. Another thing that's not really talked about much at all is there's going to be a lot of uncertainty. Okay, everyone, I think, knows that. Business knows that. There's going to be a lot of uncertainty, and that's why there's a push for the binding dispute settlement as part of this. But it's not just about that, because one of the important things will be, you know, what are the interpretive structures that surround, you know, what will be will there be an explanatory memorandum? Will there commentaries? Who drafts them? What sort of process of review is there? This will be really important, because the next category, this will be the arbitrators, or whatever they're called. It's pretty clear they won't be called arbitrators. It might be peer review, it might be something else. But they will be looking at these sorts of documents. So I think it's really important that people not lose sight of the importance of not just the technical words, not just the technical outcomes, but all the surrounding materials. And then the next one is the final decision makers, and this is the thing that came up this morning, the arbitration, or whatever it's called, but the binding dispute resolution. And I think the issue that we've always found in the UN is often when countries talk about sovereignty, I never use that term, because often when countries are talking about sovereignty, they're not really saying, they usually accept, as they have in the WTO context, for example, that you give something up, you get something in return. I think Partho talked about pooled sovereignty, and I think that's a good concept. But what they're really saying is that, a lot of this is going to be, for example, about transfer pricing. Can you have confidence that third-party experts on transfer pricing are not just going to always find for the taxpayer? And why is that? Because transfer pricing, where a lot of these decisions will be, is a very valuable skill, and most experts in transfer pricing actually regularly provide advice to multinationals on transfer pricing issues. There's not really a sort of separate academia just on transfer pricing, or not a lot of people involved who don't advise multinationals on how to structure within transfer pricing rules. And that's not a criticism of those people, but it's just saying that a lot of the big issues will be on arbitration, and there needs confidence in the system. The other thing is that the citizenry is saying these big businesses, right, Owen, these big businesses are not paying enough tax. And this is at the moment, most instances of arbitration or similar are very, very secret. The baseball arbitration has its attractions, but you have someone who you don't even know who they are, because it won't be public, making a decision with no record of that decision, which might be for a few $1 billion. Is that really, unless there's more confidence in the system, both in developing countries and amongst the citizenry, will that really work over time? And finally, again, very few people talk about enforcement. You can have an arbitral decision, but what happens if a country says, well, that was a decision, that was a crazy decision, we're not complying with it? Is it going to be like international arbitration, where you can attack their assets in other countries? Are there going to be other sanctions or so forth? So there's a lot of real issues in there which have to be considered over time. Now, I'm not going to go through every slide, I'm just raising a few. This sort of expresses that. You've got the dispute settlement, you've got the Pillar 1, which is the nexus issue and the allocation issues. Pillar 2 is the income inclusion and the base eroding payments. The developing countries are increasingly looking not just at Pillar 1, but also what Pillar 2 means for their incentives in terms of mining and other areas. Some incentives not so good, wasteful, but some incentives quite legitimate, and some incentives led to countries like Singapore are developing quite well. And in the middle I've got other pillars, and that's just a little bit of a tease, because one of there might be other aspects of this that I think people need to think about. And one of the differences between the OECD model and the UN is in the commentary to Article 5 of the OECD model. It says everyone in the OECD agrees that you cannot tax based just on a service provision into a market, saying effectively you have to have a physical presence there as well, which is not the view in the UN model. The UN model has a fees for technical services provision, for example, which allows taxation of services provided into your country purely because they've been provided into the country. And the UN model, I think, is very honest in certain areas in sort of admitting that that's because a lot of profit is made through economic engagement in your country. And even in 2003, there's a very interesting OECD technical advice group report on e-commerce. And even though it was mostly from people, advisors, corporates from the developed world, a lot of them acknowledged, as one view in that group, that maybe access to the market, intellectual property protection, access to transport facilities, personal security to the extent that exists, maybe they should be regarded as a basis for taxation without more, and looking in terms of the market that you're providing, which is of course quite an issue in the context of transfer pricing. So I'm just saying, maybe there's a sort of extra pillars to this, that by saying that in certain circumstances you can tax without that physical presence, maybe it's actually diminishing what for a lot of countries is the situation otherwise. Now, if they didn't have treaties, of course, they can tax basically whatever moves, and de jure, de facto, that might cause them some problems, but I'll mention a little bit more about that. So I, as I mentioned in another slide, I don't actually like referring this as a new taxing right, because it's not a new taxing right. In domestic law, you already have that taxing right. It's an allocation of taxing rights which differs from that under most treaties at the moment. So, but personally, I don't think it's a new taxing right. Now, underpinning the sort of the temple with all these other aspects that I mentioned is this issue of what makes a good multilateral agreement, and this again is drawn from some very good academic studies on multilateralism, and you need broad political buy-in, and that's, I think it's recognised that you need to get enough developing countries believing that overall this is a good development for them. You usually have to have a good domestic constituency in favour of the multilateral agreement. And again, this is a situation where the citizenry that's been calling for taxation needs to be, to some extent, the more moderate ones at least, to recognise that this is a good balanced deal, and that includes the dispute settlement, that they have to have confidence in the dispute settlement. Relationships to other agreements and institutions, I think there's an interesting issue. What will be the relationship of any outcome to your investment agreements? You might give away arbitration in return for taxing rights, and then find that under your investment agreements you can't fully exercise the taxing rights because it's contrary to fair and equitable treatment. And finally, it needs to be built over time and for time. A lot of people have said to me, well, developing countries are not getting anything at the moment, therefore anything they get is a good result. And I don't think that's the answer. The answer is 15 years from now, when we're locked into this, are we going to say, well, that was a fair result? Is the citizenry going to say that was a fair result? Or are they going to say, well, it's the same old, that we didn't get a good deal? And these are all very important issues that no doubt will be brought into the mix in the inclusive framework. I won't deal with all these points, but just a few of them. The unification and its components are one of the issues that's come up with the people I've been talking to, is whether the G24 proposal on significant economic presence, whether there's enough of that proposal, which was the developing country proposal, alongside the user participation and marking and intangibles ones from the developed world, whether there's enough of that, particularly in the allocation of taxing rights. There's some in the nexus. As I said, it's a question of whether it's a new taxing right, and is it really a right? As I say, I think it's really an allocation under international agreements of rights that already existed. The big issue at the moment, one of the big issues, is that where's the borderline going to be between ordinary profits and the residual profits, where the developing countries can get or the markets, not just the developing countries, can get a return on through presence in the market or the residual profits. So obviously that's a very important issue. Issues in setting the amounts. Amount C is very interesting because it's expressed to be an amount, and it's partly an amount, But as I say, it's also a way of life, which is the binding dispute settlement. And it's very interesting that that has been injected into an amount as part of the way in which the issue will be dealt with. And everyone agrees mutual agreement procedure is not a very good system at the moment. So the key, and I hope that the OECD, the inclusive framework, can achieve that, is to getting enough confidence in a system that brings more certainty for taxpayers, but also more certainties for governments. You can't just talk about certainty in the current context from the point of view of taxpayers, because governments expect some sort of certainty that where they properly levy a tax, there'll be sufficient revenue coming in as a result of that. They don't want to give away arbitration and find that all the decisions go against them, they've given away a lot and they don't get enough in return. Just a few key issues. As I've said, is don't just compare things to the OECD model. When you say, well, under the OECD model you couldn't tax just because of without a physical presence in the market, therefore it's a big change, because under the UN model in certain circumstances you could. Some countries even, or some, at least one country has taken the view that under the services PE, you don't actually need to be physically present in the country. I'm not sure about that, but certainly under the fees for technical services, you don't need to be present. On the VAT issue, I hear a lot of people saying, well, developing countries can just go for a VAT, they don't need corporate income tax. And I think this came up earlier today, and I know I was discussing it in the lift. It's not really a great response to a citizenry which says we need to tax these companies more, to say, okay, we'll impose a VAT on their provision of services to you. Whatever the economic incidence of the VAT, the public will believe they're going to be hit by it, and they might actually be hit by it, particularly if it's inelastic, the market. But and that's why you have a what's that right in Lebanon and so forth. So I don't think that's enough of an answer to say just that, well, if don't worry about an income tax, go for a VAT. Just finally, there's a lot of issues about administrability. Developing countries are still pushing for withholding taxes, saying that, in principle, we like the idea of taxing on net, but it's hard to find that out in many cases. There's issues of informational gaps. How do we know what the relevant situation is? And there's accounting principles, because I think there's a reference to the accounting principles applicable in the headquarters of the M&E, but there'll also be adjustments for differing accounting standards. And business has said to me that could be quite difficult. And this is not to be critical of these things. I think it's a really good attempt by the OECD to raise these issues. And now the issue is how the multilateral process will go on. Big issue that came up in the public discussions in the UN Tax Committee is the economic analysis and the importance of economic analysis. People want to know what the results are before advising the ministers. Now, good luck. It's going to be hard to get a really definitive economic analysis. But what I think it shouldn't do is say, as I've said, well, you're not getting anything at the moment, so anything you're getting must be an advantage, because I think it has to be dynamic economic analysis, and it has to be economic analysis about how this will look in 10 or 15 years. So there are really just a few comments, and I think I'm basically within time with that.
Well, thanks very much, and thanks so much for inviting me. It's been a very interesting day. The day's gone pretty quickly until this moment, at the very least. So I'll try to be fairly brief. Well, I can probably start. Do you have it somewhere? Should be there somewhere. So basically, I'm going to talk about the future of international tax from a kind of perspective of an economist. And I sort of do that slightly unapologetically, because I do think that at the end of the day, the economics is going to drive where the international tax system ends up. Which isn't to say that politics has no role, but the politics will be driven by the economics, and the economics will kind of define the battlefield at which the politics takes place. So I think, for example, if you think about the arm's length pricing principle, And I think we at the fund have been as critical as anybody of certain aspects of the arm's length, principle of arm's length pricing, but it is a principle, and it survived, I think, largely because it is a coherent principle. It's a principle that tries to avoid distorting organizational form by looking at the entities rather than going for a unitary approach. So I think that having a clear underlying principles is going to be important for sustainability of any kind of system. And again, so I think illustrating the power of the economics, I'm going to be talking mainly about a paper we wrote earlier this year, but we wrote a paper in 2014 at the fund about the same topic, future of international tax, at the beginning of the BEPS process. And in that paper we talked about destination-based taxation, we talked about residual profit allocation, and everybody said we were kind of somewhere between heretics and lunatics at that time. 5 years later, basically, the OECD Secretariat element has elements of both. So, you know, I think I make my plea for the role of economics in all this. So, as I said, I'm going to be partly talk about this paper that we wrote, I think came out in March. So it preceded the kind of the Pillar 1, Pillar 2 distinction Michael talked about. But I think actually, if anything, because of the way things have developed in the OECD inclusive framework, some of the ideas are probably even more relevant than they were when we wrote the paper. So if I can figure out, so what? No, that was quicker than I actually expected. No one's going to complain, right? So okay. Okay, so I could do it backwards. That would actually. Well, now you've seen all my surprises are given away. So I'm going to say a little bit about what are the issues, why are we worried about this, a little bit about the options, and then some reflections on the OECD Secretariat proposal. So if we talk about issues, why are we worrying about all this? I'm not going to go through all the bullets and so on, but well, we think about profit shifting as a concern. So this table simply gives some estimated numbers of the proportion of corporate tax revenue lost as a consequence of profit shifting in various countries. Two things to take away from this table. One is we don't really know all that much about it still. There are some countries we can't even agree on the sign, whether a country is a winner or a loser from profit shifting. Really only the US is the only country I think we have a good take on this. The other question I think is, well, are these actually big numbers or are they small numbers? And you could certainly make a case that so for many of these countries, these are actually quite small numbers because the corporate tax is not the biggest revenue raiser. And I'll actually come back to that in the context of something Michael said. I think we worry too about tax competition. And I think one of the points we try to make in the paper is that probably tax competition, in a broad sense, at least if you think in terms of revenue, is much more of an issue than corporate tax avoidance. That when we look at the kind of numbers you get for corporate tax avoidance, and you compare that to the revenue loss from even quite small reductions in the overall level of corporate tax, even statutory corporate tax rates, these kind of losses are dwarfed by what we've seen on the corporate tax, even the headline rate. I think there are, and I'm not going to go through these things, you can see that actually even during the BEPS process, corporate tax rates continue to fall in the G7. You can even argue that the BEPS process is going to make tax competition worse, because if governments cannot essentially compete by allowing various avoidance devices, they're going to have to compete in terms of the core tax system, and actually compete more for real investment, not just for kind of paper investment. I think the other kind of thought I would mention on the tax competition headings, we talked about, and I know many people don't like the term, we talked about these sovereignty issues this morning. And I understand that dispute resolution prevention is a large part of that, but clearly for many countries, a large part of the issue of sovereignty, in inverted commas, is to do with blacklists, EU blacklists and other things, and notions of harmful tax practices, which, to be honest, we don't really know how to define harmful tax practice in a coherent, sensible way. Why is a system that has a zero tax rate on some things and a 10% tax rate on other things, why is that worse than a system that has a rate of zero on everything? I know that's not quite what the harmful tax practices say, but just to make the point, there's a whole set of issues there. Which reminds me to say, like Michael, I don't take what I'm saying as IMF views. These shouldn't be attributed to the board, management, staff, or anyone vaguely associated with the IMF in any way whatsoever. Third issue is the developing country one, which Michael has touched on, and I think these are some numbers we gave a few years ago, but I think now it's generally accepted. If you think about these profit shifting numbers, in dollar terms they're clearly much larger for the advanced economies than for developing countries, but if you think of these numbers relative to GDP or relative to tax revenue, it's much more of an issue for developing countries than for advanced. And there, I think, in a way, it's not, I think, just revenue, but I almost turn one of Michael's points around the other way and say that actually you could say for advanced economies, why don't they just get their VAT fixed properly? And it wouldn't be a huge issue. But I agree with Michael, when you think about developing economies, you know, the VAT is under stress already in many of these countries. The personal income tax doesn't work. Tariffs we're trying to reduce. So it's really an issue for developing economies. So rather inverting Michael's point, I think about the role of the VAT. On the digitalization debate, again, I won't go through it. But certainly what we argue in the paper is, apart from this question, well, what's really new with digitalization? Is it just a matter of scale rather than of nature? But I think we also would take the view that, and I think this is probably now, the language has moved on, we can probably be more forthright than we were before, that the idea that taxing where value is created is going to take you very far in terms of allocating taxing rights. To be honest, it's not going to happen. It just really doesn't help. Everyone could nod wisely and say that's what we want to do, but then when you say, well, where is the value created? No one agrees. And even going back, I think, to one of the League of Nations things in the 20s was basically saying much the same thing. So here's a bunch of the issues. What are our options? Well, firstly, we should think what are the criteria by which we might judge a sensible international tax system. And there I would say, well, actually, for international tax, we don't, as economists, have as strong principles as we have for domestic economies. For domestic economies, at least, we have some fairly robust principles that say you don't want to tax business inputs, which is kind of the rationale for VAT. But those kind of principles actually don't extend to an international context. There are very few simple principles, almost none, I would say, for international tax, except kind of going back to Irina Mitchell's paper. There's a strong case that we want to tax rents somewhere, because that's an efficient source of revenue. So there's a strong case for saying if there are rents out there, we want to tax them somewhere. And there, maybe parenthetically, let me make another remark, is that all these conversations about the future of international tax and corporate tax, they always end up with the question, well, why do we have a corporate tax at all? And I think you can't, ultimately you're not going to be able to differentiate between these two things. You're always going to end up with the question, what is the corporate tax trying to do? Do we really just want to tax rents? If that's what we want to do, let's think about domestic corporate tax reform as well as what we want to do on the international side. So pragmatically, what you might look at, and I'll come back to this later, is you want to think about, given that we don't have any great universal principles, we think about vulnerability to profit shifting, we think about tax competition. The square brackets are because I'm not quite sure what harmful tax competition means for an economist. And then some fairly easiest things, administration, compliance, legal obstacles, blah, blah, blah. And of course, when you assess these alternative options for corporate international tax design by these criteria, it's going to make a huge difference whether you're talking about one country adopting it or everybody adopting it, which I won't particularly get. Well, like for example, the destination-based cash flow tax, we can make a case for adopting that at global level, but we know that if one country were to adopt it, one large country, that would be pretty disastrous for everybody else, because that country would just instantly become a super attractive low tax jurisdiction. So I'm going to just talk, and I'm not going to go through them all, I'm just going to talk through some of the things that we look at in the paper that also I think tie in with the Pillar 1, Pillar 2, secretariat issues. Well, we look at what's called, we called it then minimum taxation, which is very much the thing that Michael was talking about, the Pillar 2 aspect. So the kind of the outbound, the kind of the guilty type aspect of the capital exporter imposing a minimum tax on income arising abroad. The inbound, which is more the kind of the beat thing, which is the capital importer, putting some kind of limit on the deductions of payments going out of the country. And I think, as Michael was, I won't say more about this, I think this is essentially Pillar 2. And more, I think, developing countries are really looking to this, and particularly, I think, to this part here, as being the critical thing. So one big issue is what the balance between these two is, because in some sense you may not need both. And one argument is, well, if you have this, that actually, if you have the kind of the residence country imposes a minimum tax, that's actually good for the source country, because they can then increase their tax and soak up what would otherwise be taxed in the residence country. And that's sometimes said to say, well, why we might as well go this route. Of course, you might turn it the other way around and say, well, if these two things are equivalent, why don't we do it this route, which is the one that developing countries might prefer. There's the destination-based cash flow tax. I'm not going to say much about the destination-based cash flow tax, maybe just to make a couple of general points. Why are economists focusing on destination-based tax? And I think it's quite different from the rationale given in some of the proposals around at the moment that have been made over the last year or so. For economists, the point about destination-based taxation is nothing to do with fairness or to do with value being created in the destination country. It's an efficiency argument. It's based on the ultimate rationale for economists is destination-based taxation becomes robust against avoidance because final consumers, the assumption is, are not very mobile. So it becomes an efficiency argument. You tie the tax base to something that's immobile. So it's not a fairness thing, it's not a it's not a value creation thing, it's an efficiency thing. The point that leads on to, and actually Mitchell touched on it sort of somewhat elliptically, I think, is that actually the key thing for that is not destination basing. It's not having some tax right in the selling country. It's the border adjustment. That's the crucial thing. Because that's why with destination based, for example, formula apportionment, you do get distortions. Because of these kind of low margin distributors, you do care where you sell your product. It's the border adjustment. Border adjustment is really the crucial thing here. And that's an efficiency argument. The other thing to note is that we tend to assume destination basing is bad for low income countries. Not clear that's necessarily the case, partly because they all run, I shouldn't say they all run, many, even if when you take out resources, have pretty large trade deficits. And that means in revenue terms, at least, destination base is not that bad for them. We can argue about long and short run, but I think, and this is something we've learnt, I think, we shouldn't kind of instinctively think destination bad for developing countries. I think there's more work to do on that, but it's not obviously always and everywhere the case. Formula apportionment, I won't go through in much detail, except to note that we know that, I think this is now well known, people tend to think formula apportionment is going to be good for low-income countries. Of course, it depends on what the apportionment factors are. If you use employment or even to some degree sales, that makes it rather better for them. But then let me say a bit about residual profit allocation. So in the textbook, residual profit allocation does the following. Just to explain, I'm sure many of you know, it's a kind of a hybrid. You say, let's figure out some kind of routine profit, which to economists, it's not exactly the same thing, but economists naturally think of this as a normal return. We think of a normal return, which you figure out either by arm's length pricing or by applying some kind of markup. So you figure out routine profit, you allocate that for taxation where the functions or activities are performed. What's left over is some kind of residual, and which corresponds pretty much for an economist, this is close to being rents, and you allocate that by a formulary method. So I'll talk a little bit more about, we've been doing some empirics on that, but I'll say a little bit more about that actually a slide or two along. So that's what we mean by, well, I'll make one point, a couple of points here. So, of course, one of the difficulties, and Michael was emphasizing the importance of economic analysis in all this, it's very hard to figure out put numbers on routine and residual profit. It's not something that companies report in their accounts. You have to basically invent it. So we've been doing some such inventing, and a couple of points come out. One, I'll come on to the other one later. Not surprisingly, these residual profits, when we work them out, are pretty much all concentrated in US headquartered firms. So the idea that we're really talking about US multinationals, in that sense, turns out to be wrong, to be right. The other thing that if you were to allocate routine profits, for many low-income countries, that suggests they would raise more money by taxing routine profits than they actually do at the moment. So many low-income countries in particular don't even manage to tax routine profits effectively. And so this is we agonized over whether to include a kind of a heat map of this kind. Many people hated it, including me. But actually, I've kind of got somewhat used to it. So basically, these are the various sort of schemes. This kind of the minimum tax, the Pillar 2 things, destination-based formula apportionment, RPA. And these are by the criteria that I talked about. You can go through that and figure out, well, is there one scheme that the IMF prefers in the sense that it dominates another? And we've carefully made sure that no, there isn't. But certainly if you go through and put weights on the various criteria, you can end up with some preferences. But let me just say a little bit more about the empirics. So as I say, we've been doing work on residuals. We have this result that they're largely concentrated in US companies. The other thing that comes out, and I think it's to do with some of the empirical difficulties as well, is that many large multinationals appear to have negative residuals. So there then becomes an issue, if you do have residual profit allocation schemes, what do you do with a negative residual? Now, some of the schemes seem to have the feature that you would tax the positive residual, but not give any kind of allowance when the residual is negative. That may be convenient, but if I were trying to think of a way to discourage innovation, that's precisely what I would do, right? I would give no allowance for a negative residual, and I would tax a positive residual. The other thing to note is, well, when we think about the empirics, clearly people care about who's going to get the money, but it's not the only thing that matters. For example, what do these things do to incentives to invest? And that turns out, we've been thinking about this for the residual profit allocation schemes, turns out to be pretty complicated. For example, under the textbook residual profit allocation schemes, you may choose to tax routine profits at a different rate from that at which you tax residual profits. Why not? They're different tax bases, why not tax them differently? And depending on how you think that works out, you can end up with actually very high effective marginal tax rates, large discouragement to investment. And I think some of these things carry through to my final point, my final couple of slides, talk about where we are now. So just to reflect a little bit on the unified approach, which is the OECD Secretariat proposal, very impressive work, I think, coming out with a possible way ahead. And then we just make a few points. I think one way, and it's maybe not completely fair, is one way to think about this conceptually is one could think of it as moving part of the way to a residual profit allocation scheme. The difference is, as I understand it, how I would think about it is that under the textbook residual profit allocation scheme I was talking about, you would allocate all the routine return to where the functions activities take place. As I understand it, the part B is really allocating only the routine return arising from marketing and distribution activity. So there's an element of the routine, sort of more limited version of the treatment of routine returns there. And of course, the full residual profit allocation would allocate all of the residual profit on a formulaic basis, share it out between countries, not just some part of it. But nonetheless, when I think about it intellectually and how I would model it, I find it helpful to think about by some kind of partial analogy with residual profit allocation, which raises all kinds of issues as well. So, for example, is it obvious that countries that are allocated some of the profits under Part A, which allocates part of the residual to marketing to the market country, is it obvious they would tax that at the same rate as they would tax other corporate income? Not clear to me. Why you could certainly have a different rate if you wanted to. Don't see why not. I don't know whether you'd want to set that higher or lower. I don't know quite what you'd want to do, but it's going to have an impact on, for example, incentives to invest. Second point I would note, apart from the spelling error, that should say roll. Apparently toll is a real word. Didn't get picked up by spell check. I have no idea what it means. But I would give full credit. I think it's historic. I think the OECD Secretariat proposal is truly historic in giving a role for formulaic methods, in giving a role for market countries, which I tend to think called destination countries. We're not quite at the point where I can call them destination, but I can call them market. So I think this is really quite historic. And you know, for an economist, you look at this system and you say, really nothing has happened. I know things have happened, but for the economic side of the perspective, really nothing's happened for 80 years or possibly 100 years. And now we have really big changes. And that sort of leads to a couple of further points as well. That's true. And you know, I think this idea that we focus on the residual is really saying the rents are the issue. And that ties in, I think, with my earlier point about, well, all this has got to tie in with what we want the corporate tax to do at some point. The final couple of points, they're pretty obvious, I think. You know, if there were a reservation, I think it would be that it's not clear what the overarching economic principle is here. It's the unified approach is a kind of hybrid of a little bit of formulaic methods, a little bit of arm's length pricing. And the thing I'm struggling with, maybe the answer is obvious, is that I'm not quite sure how you mix formulaic and arm's length pricing, traditional arm's length pricing at the same time. But maybe we'll figure that out over the coming months. The other thing, of course, and this is something for Ben to worry about more than me, is that the timetable for this is just like amazingly rapid. To try to get any sort of agreement, even on outline, within the next year, I think is best of luck, really. Well, no, I mean that not in a genuine way. And then finally, water pillar 2, which I think is crucial both to address tax competition and for the low-income countries. And this issue that I mentioned before about who gets to top up to achieve the minimum, the source or the residence country, which I think is, there are going to be some arguments say, well, it doesn't really matter, but I suspect at the end of the day it does, which way around we give these things. So I think maybe that's all. That's more or less, I think, what I have to say. So thanks very much. Thank you.
Thank you. Thank you, Eduardo, and thank you for inviting me. I think all the people who might be useful to you in this debate are actually working in Paris 24/7 to come up with the answers to the difficult questions that Mick and Michael have raised. And not for the first time, Mick and Michael have actually put on the table most of the issues that I was going to raise about some of the features of the international taxation system. And I did have endless PowerPoint slides to explain the digital project, as it's called. But you've heard quite a lot about that already, and it might be a case of death by PowerPoint at this time on a Friday afternoon. So what I will do instead is reflect a bit on what has been said already by Mike and Michael, and just raise a few points. So maybe the first about process and the issue of inclusion. So the big issue for the OECD and for the UN and the IMF and the World Bank is really about how to balance the interests of different countries. And what we're looking at now is the OECD has its narrow membership, but we're looking at trying to work in a committee format with 134 countries. So you can imagine a committee might normally fit in a room this size and do committee work, which means looking at papers and agreeing things and trying to come to a conclusion on things by consensus. And the reality is we have to do that now in the scary timetable that Mick rightly identified. We have to do that with 134 countries, and by the time it's finished in the middle of 2020, there may be more countries too. So you can either think that you can approach this inclusion issue in a couple of ways. One is to think about fairness, equity and voice. Or you can think of it, the interests of the powerful countries who want global rules and therefore acknowledge that you've got to talk to more than their usual partners around the world. But it doesn't matter. I think the outcome is the same. The doors have been blown off these narrow exclusive discussions, and there is no turning back. So that is the first point about the future, that inclusive decision making is definitely here to stay, and it raises all sorts of complexities, not just for the OECD but for the UN and others who are concerned with norm setting. And I don't object at all to the difficult questions that Mick has raised about some of the technical issues, but the reality of the task is what will the consensus bear, and that is the practical reality of doing these types of negotiation. And the issues of principle are not unimportant, of course, but the reality is, in a timetable that is so compressed to get decisions, compromises are made. So that's the first future issue. Inclusion is here to stay. That's the future. I've no doubt about that. The second issue is what I call the kind of reducing chaos or reducing tension in the international system. And I think I disagree a bit with what Michael said. I think the tensions in the international system are presented as technical, but they are fundamentally now, I think, about the problem of taxing rights. They may not be new, as you were suggesting, Michael, but that is the problem. And the kind of tax wars that we've seen on digital service taxes, this is a kind of an acute and extreme test case of the problem, and I'll say a bit more about why that's driving the timetable. And I think many of the ideas inherent in the problem of the allocation of taxing rights are about restoring the balance to the claims of market jurisdictions. And this is so important because we know already that tax wars lead to trade wars and lead to all sorts of other problems. So let's not underestimate the importance. So I think a third theme is the focus on multinational enterprises as a group concept. So the Mick was very nicely saying that this is all very exciting and hasn't been looked at for effectively 100 years, and we like to think that's true. And the principle of the single entity approach, which was established in the 1920s, has not really been revisited until now. And there's clearly much dissatisfaction with that. And I think what the OECD intends to do on Pillar 1, which I'll limit my comments to Pillar 1 mainly out of interest of time, is that the digital work, taking group profits as the idea, is largely unprecedented, although you could argue that issues like country-by-country reporting in the BEPS project started to set the way in which we look at the departure from the single entity dominance. So where are we now? I think the fourth issue is, as Mick was saying, is about formulas. So the OECD always rejected formulas, but once you look at an M&A group in its totality, then you don't really, I'm not sure you have much choice. There's kind of no turning back, and you've got to try and take the least complex route. And this is the argument goes is the best way of rewarding the value in the market jurisdiction. That is taxing rights. We can argue the toss about who benefits and loses from this approach, the formulaic approach under Pillar 1, Amount A, as those of you following this will know. The analysis that we're doing now, the economic impact analysis, will be out at the end of the year. We don't know what the answer to this is yet, but it looks like developing countries, which is concerned to many of us here, I'm sure, looks like they will gain somehow. But the range is very complicated to determine, and as Mick says, I mean, there are incredibly difficult technical problems to work out how this will work. But for those of you who are kind of following this, want to know what the results look like, there will be something public at the end of the year. We are then worrying about the fixed return issue of the marketing and distribution activities, so-called Amount B in Pillar 1, and what the economic analysis of that looks like. And then we're going to try, although this is, I don't know whether this is harder or easier, probably harder, but looking at the minimum tax issues in Pillar 2 and the economic impact analysis of that. Very challenging, and I don't know when the results of that latter piece of work will be out, but we're looking at a second public consultation on that process in the middle of December. I think maybe enough about what has been said about the tensions of the arm's length principle, but Michael talked about dispute resolution and its importance. I mean, clearly the tensions over the arm's length principle and the tensions over the single entity approach and unilateral measures that are out there, there are bound to be disputes, and more of them are getting more and more complex. So this is going to be here to stay and puts enormous pressure on the dispute resolution system that the work at the OECD comes up with, and we're acutely aware that of the problems of this for developing countries in particular, with arbitration and so on. And I mean, just to highlight that this is here to stay. And if we look at the OECD's work through its transfer pricing guidance, I mean, the pre-BEPS documentation looked like 300 pages, and the post-BEPS document now is 600. So that can't go on, and disputes may be rising in the same way that the number of pages that are produced arising too. But just to make that point, that a solution to this is absolutely imperative. So, bringing these things together, the Secretariat attempt to look at what we're calling the unified approach, which is the Secretariat's view on what a consensus of hundreds of countries might bear, given the dominant proposals put forward by 3 or 4 countries or groups of countries. So what we're trying to do is to bring all these future themes together in one place. So address the issue of inclusion by giving developing countries a genuine voice in the process. And there's been a bit of misinformation out there, particularly by civil society, about whether developing countries are observers to this process. They're not. They have an equal say in the development of the rules in legal terms, although it would be naive to say that the asymmetries in the world mean that they are able to participate in the same way as the rich and powerful countries, that we're not stupid. But they do have, this is our attempt to give genuine inclusion to the process. The OECD has traditionally been a place with a narrow membership where the rules are controlled by a narrow set of countries. That is no longer the case. We will look at the M&Es as a group. That's going to be there to stay. We're looking at the issues of formula. Try and reduce the arm's length uncertainty issue through Pillar B on this fixed margin, this fixed return to some functions, and think through again a new dispute resolution system. So this is a lifetime of work which has to be done for the G20 in the next 6 months. So that's the task at hand, and you'll see why maybe all of the answers to all the questions are not there yet, because this is a monumental task. So I think I'll leave it there, and happy to answer any questions. Thank you.
Thank you very much. I would like to make two points, one historical and one economic. This is what has been going on over the last 200 years. So we've seen basically 3 globalization booms and 3 busts. The first globalization was the concept of Europe, that it started with the defeat of Napoleon and the First War. Then a very short globalization under the League of Nations, 1919 until the Wall Street crash, and then the Second War. And the third globalization was the United Nations system that arguably collapsed in 2015 for a number of reasons I identified in my paper. So we are here. So now I think there is a credible risk of the war, that this time could be nuclear. And tax system is something that could help to minimize that risk. But my feeling is that in terms of, from a history of globalizations, now there is a credible risk of facing a new global war. That's my historical point. My economic point will be the following. My feeling is that at the end of the day, we are dealing with a benign cartel, a cartel of countries that are trying to protect somehow the tax base. There are a number of options available, but the problem is that this cartel is quite unstable, very unstable, because the behavior of countries is opaque. So politicians are saying one thing, but in practice they are doing something many times different from what they are saying. So regardless of the regulations that is eventually suggested by the OECD next year or by the G20, my feeling is that in order to bring stability to this cartel, it is fundamental to make the behavior of countries as transparent as possible. And one fundamental way for doing that, I think, please correct me if I'm wrong, is by making MAP somehow public, or tax arbitration somehow public. That would be the ideal thing. I could say plan A. And plan B, I think, would be the following: to allow that all countries involved in MAPs and tax arbitration may have the duty to inform the OECD, for example, or the UN, or the IMF, what on earth is going on each of those MAPs and tax arbitrations. And as soon as, for example, the OECD sees some regional or global convergence on how to deal with certain problems, transform that convergence into the OECD commentary in order to make the system as transparent as possible, because my feeling is that there is a quite important inbuilt instability in this cartel, which is the increasingly opaque behavior of countries. And I will stop here, and in order to, I don't know if it makes any sense. The historical point and the economic point, and to what extent it could be possible to make maps somehow visible, at least to the OECD.
Can I just make a quick comment on that? I think there's some good developments on making, I mean, you can have court systems, court decisions on transfer pricing which are redacted. I've really never seen why you couldn't have it on a map, and I think it's tax officials wanting to keep keeping map very much to themselves. That's why the arbitration at the moment is embedded within the tax system. It's the competent authorities agreeing to follow the arbitration result rather than the arbitration result acting per se. And also I think there are some good developments in European and Canadian practice in terms of having a more general jurisprudence, having a more standing body which can look at some of these issues. So I think it is central, as I said, that there needs to be confidence in the system, and it's not a criticism of anyone, but not enough attempt has been made to build confidence in an arbitration system. And for developing countries, most of the experience is of arbitration in investment agreements. And if you ask developing countries about arbitration investment agreements, they say it's caused too much uncertainty. So, because of the decisions by panels about fair and equitable treatment and so forth, and decisions which are different, and secrecy. So that's why saying that, having as a premise that system will bring more certainty is something that causes some issues for developing countries. But I know the OECD is aware that it probably won't be called arbitration. They're looking, I know, at other ways of having a system which is decisive and gives sufficient confidence to taxpayers. But as I say, there needs to be, just as investment agreements were seen as, with arbitration, was seen as creating too much uncertainty for regulation by countries, including health, cigarette labelling and so forth. There is a concern in a lot of developing countries that arbitration, or its simulacrum, as I sometimes call it, will bring too much uncertainty to the revenue side of so there might be certainty for taxpayers, and it might be certainty for taxpayers because the system might be sort of geared towards taxpayer-friendly decisions, just as investment decisions are geared towards investor-friendly decisions. And you know, everyone's aware of that issue, and the problem is building confidence in such a short period of time. And just a final point, of course, that for a lot of developing countries, they say, well, why are we bound by a timeline that the G20 has given us? We're not part of the G20, and I know there's good reasons, as Ben will say, that something has to be done quickly. But a lot of developing countries say to me, well, what this timeline is crazily ambitious, particularly for developing countries, and we can't send everyone to every working party meeting at the OECD. So why are we bound by a G20 timeline, which we weren't consulted when it was set? Ben will have a response for that, and there is a need to act.
Thank you very much.
Okay.
Yeah, I mean, not on these timetables. If we reflect on the BEPS project, we faced an even more ridiculous timescale to do the 15 actions, and it was tasked by the G20, but the G20 said you've got to make it global, so it wasn't just for them. But I think there's no doubt that the BEPS project wouldn't have come up with anything if the timetable had been more, let's say, sympathetic. It would have failed because the political moment was such that you had to capture it. And if you didn't capture it and come up with something, I think it would have failed. And I think a lot of countries would have lost faith completely in any kind of multilateral process, and that was a kind of time and place issue following the crisis and so on. I think you're right that to caricature the system as an unstable cartel. That's right. I'm not sure whether transparency is the way to make the cartel more stable. There are lots of things that are going to be needed to make this cartel stable, and they include some results that this vast coalition can bear. I mean, we had a similar debate about country-by-country reporting and whether transparency would actually deliver something much more significant. And the developing countries told us they didn't really care. They are not fighting for public country-by-country reporting. It's others, civil society and so on, that are fighting for public country-by-country reporting. Developing countries want a proper risk assessment tool, and they don't really care who else has access to that knowledge. They want it. They want the global view. The map thing is clearly really challenging for the project that we're dealing with, but Michael is right that there is no global faith in the system, so it's basically got to be reinvented, and that means looking afresh at all options, including independent processes, third-party processes, and how that all gets designed is. I mean, it was why I was late for this conference, in fact, because we're having a call about it, and it's really difficult. So. But I'm not sure the transparency element is the critical factor.
If I may, I had a couple of thoughts prompted by your remarks. One was sort of, actually seeing the slide again made me think, well, where in the slide has the world had a well-functioning corporate tax, income tax system? And actually, one is in the gap, First World War. Everybody had very good excess profit taxes, worked very well. Similarly, in the Second World War, not quite so good, but we had excess profit, which were rent taxes, which were basically allowance for corporate equity schemes, worked very well, and a kind of a short subset of the UN period for most countries, the corporate tax has been. So that then led me to the thought, well, okay, the instability, I think comes back to my point, we always end up with what is the corporate tax there for? I mean, is the corporate tax going to wither away? And would that be such a bad thing? I mean, in a way, the default situation is that we end up with a little bit to Ian's point. We may end up with a kind of the standard corporate tax withering away, some kind of value-added taxes, trying to keep taxes on labour income pretty low, and maybe that's not such a bad outcome. It's a tax on rents and wages, if it's well done. So I'm being slightly, provocative in a way, but I think you always end up to say, well, why are we preserving the corporate income tax, which I think is clearer, again, much clearer for low-income countries than it is for high-income countries. High-income countries, you could perfectly well say, I think, that, apart from kind of salience issues and public perceptions, that many high-income countries would be better off with a well-functioning VAT and trying to keep taxes on wage income low. Be a rent tax, and anyway, so
I think there's an extra point too. Then I agree. In developing countries, it's much more important, at least at the moment, than corporate income. But not just for the money it brings in proportionately, but also they're trying to convince people to pay their taxes, and people see that corporates are not paying their taxes. There's a psychological element. That's not economic analysis, but it is. I think it's a relevant factor at the moment, and I think that's why I think transparency is important. It's because the perception, the citizenry is more active on these issues, and the NGOs, particularly in some countries, have linked in very well, I think, with the citizenry perspective. And it's actually, from the UN point of view, it's very important because the beneficiaries of a lot of these taxes are people who don't actually pay taxes because they're earning far too low. So I think that issue is I think it will become increasingly important, not just in this process of the OECD inclusive framework, but more generally. How are you going to sell this to the citizenry, including the citizenry that doesn't pay tax but is the beneficiary of the taxes?
You can. This is an important point that you could argue that all this is noise for much of the world, and why on earth are we focusing all our efforts on it when many different countries in the world are struggling with the informal sector, they're struggling with VAT implementation and refunds and so on, and no personal income tax. Well, why are we talking about this? Is just noise created by the rich countries. Well, I suppose the answer to that is, as Michael was saying, that how the biggest and most high-profile taxpayers do or don't pay tax, or seem to be paying tax, has a massive impact on tax morale, and so it's important for that reason. And you can't tax. You've got to sort this stuff out if you want to tax domestic firms properly too. And I think maybe that is the only argument.
I think you can almost turn some of these arguments upside down, because starting from the premise that the corporate tax is much more important for developing countries, the relative withering away for the rich countries actually has the problem that with the sophistication of their systems, the costs become much higher. So in fact, the value of the corporate tax becomes for the developing countries, and it becomes costly for the developed countries, which makes it, in a sense, more important for the developing countries to get their share, because they have a stake in the system. And if it's not working for them, then there's a greater risk of what they're left with being undermined. So in a sense, getting it to work for them is critical. And I think your point about transparency, and Eduardo's point about transparency, is a good one. But dare I raise the question of Brexit? You have a situation where people in the UK who are in favour of leaving don't like the role of the European Court of Justice, even though the UK has a stake in it. But the substitute, under whatever system replaces it, is going to, looks likely to be some form of opaque arbitration, which will not be visible, will be performing the same role between the UK and the EU, but under the table, so that no one is worried about it.
Well, they will start worrying though at some point.
Well, at some point, but if you don't know these cases are happening, you don't worry about them, right? If they're not visible, then they're not creating
that's
the
where
problem.
journalists will make it visible.
Well, they may or they may not. It depends. They may not have the same interest in doing that. My point in this is that transparency by itself is not a guarantee of citizen support and solving saliency.
And you can be misinterpreted. I mean, that's the classic issue.
Yeah. But if I to come back to it, in a sense, at this point, in terms of confidence, it's about building expectations. So it's about designing a system that is sufficiently predictable, and that may be a reason for bringing in arbitrary elements to it, precisely to increase the predictability of them, and the trick in making it last for a long time, to pick up one of your pillars, is maybe finding some way to build these arbitrary elements with sufficient flexibility that they can adapt in the future. So, I mean, having fixed percentages that are fixed for all time as opposed to having processes may be the problem. So, in a sense, you want to be able to resolve disputes at a high level, not on a case-by-case basis, but have sort of multilateral dispute resolution of classes of cases rather than individual cases.
But I mean, here we are. This session is entitled "The Future of the International Tax System." Yeah, I mean, we are still talking about something that seems to me to be quite narrow. I mean, why we should be talking about all sorts of other elements of the tax system. Yeah. And we should be talking about the institutional architecture. Why isn't there a World Tax Organization? Should there be? I don't know. But the issue about the future of taxation should not be just about the corporate space, but we've somehow made it that.
But I think the developments that we're going through are actually showing the value of doing it, because it's creating the multilateral institutions. Now, the OECD Council of Europe Convention has gained life. Cross-border enforcement, which used to be totally excluded by public international law, has become a factor. There are, the inclusive framework does provide, a global institution nascently, in the same way that GATT did for world trade. So it may be that the dealing with these highly visible issues is the price of getting the institutional basis to deal with the really important issues.
I hope that'll be so.
Nice to see.
No, I would hope so. We don't see many signs, I think, but I would agree with Ben. I think that it is important to bear in mind that even though we come up with big numbers for revenue losses for developing countries, they're never going to get that back. I mean, they're big numbers, but they're never realistically going to get it back. And I think when the G20 comes to focus on, as what Ben says, making refunds work properly in low-income countries under the VAT, then we'll have made some real progress on that.
Or attack the criminal space.
Yeah.
Why are we not talking about taxing criminality in the way that we're talking about profit shifting, which maybe that is the ingredient that needs much more attention, because you can easily argue that the losses to developing countries where the rich countries have a particular responsibility for being safe havens on asset recovery and so on
But I think also to the transparency point, I'm also slightly sceptical about the value of transparency itself. I think there are all kinds of examples of government being very transparent about things, but nothing changes. I mean, I think, in the UK, the classic example is a zero rating under the VAT, where everybody knows this is a stupid way of doing things. All policymakers know it's very transparent. Nothing ever happens. So I'm slightly sceptical about it. But I do think, as a profession, we may have some responsibility, because the level of public understanding of taxation and incidence issues is just so bad. And I think as an economist, I think we've done such a terrible job of getting people to understand some basic public finance notions that even if we look at these corporate tax issues, to say that, people think, because I buy Starbucks and all this kind of stuff, and they should be paying profit tax. Well, just to say, that's a VAT issue. That's not a corporate tax issue, and we never got that across. I don't know how we do it, but I think it's a problem of our own making to some extent.
Just on the predictability, I mean, one of the big issues that I hear a lot is that obviously whatever is decided here will be locked in for some time, and the problem has been the change of business models, and they're probably going to exponentially change again. And of course, for a lot of developing countries, and I'm sure some developed countries, they think, what happens if we end up with a system that has some negatives for us, but the positives we thought were built in, we don't get over time? And I mean, having worked in the OECD and the UN, I know the OECD and UN result is to change the commentaries every once in a while and sort of reinterpret what this was intended. So, I mean, you'll still have that constant poacher gamekeeper.
Which is important, because the developing countries are constantly chasing an elusive capacity, which, and I better do what you guys have done and say that this is my personal view at this point, but the idea that poor countries in Africa will ever be able to front up to the highly paid tax lawyers who are looking for the next loophole, I think it's fanciful. And we need to go back to some of the maybe uncomfortable ideas that developing countries contract in expertise for particular challenges, as they do in all sorts of other areas of public life. Whereas in the tax world, we seem to be saying, let's have another training course or another seminar, endlessly churning these things out. with the idea that you will get to the necessary capacity threshold. I think it's questionable.
I agree, but a good example of that is arbitration, where I know in investment arbitration, countries they always get an American or a British firm involved, and it's incredibly expensive. Whereas the WTO system has an architecture whereby developing countries can seek assistance from very well qualified people for free, so that they do have that, more of a sense they're in an equal space and can front up against.
Well, in that case, a quick advert for Tax Inspectors Without Borders. Compulsory.
I have to do mine after, but
okay, that's fine.
You have to do my
capacity, which is delivering auditors to developing countries, and they do try and build capacity. But what they're actually doing is doing the audits of big companies on behalf of developing countries, and they have recovered millions. We're up to $500 million. So. I know you were saying there's not much in it for developing countries.
No.
There are things you can do. How you do it seems to matter greatly, and there are revenues there in the best space for poor countries.
I'm not going to disagree.
No, you do your advert.
Well, no, I went to my advert. No,
my quick.
No, but I think what you say is correct. I think also that go back to the earlier point that actually the future in the end is not in the corporate tax, it's in the VAT, it's in property taxes and the income tax. And there I think you do just have to build the homegrown capacity, or removing the, improving customs administration there. I think it is just a long slog, and it's, this shows up in points of GDP, but not in 6 months. It shows up over 5, 10 years. But so Michael's advert. Just check our website. Okay, it's too late in the day to do that.
Now, very quickly, our ad is that what we've found in the UN Tax Committee is they're very divided on these issues. They weren't able to produce a paper for the last meeting, and I think a healthy division, because there's a lot of uncertainties that they're going through, and also because they're waiting for the OECD paper. So as Secretariat, and we're working with them on they'll probably do a submission to the OECD Secretariat on the paper, but it'll probably be a list of issues, and probably nothing will be new, but that'll probably be submission from the Commission itself, committee itself. But from the Secretariat point of view, we thought the best space we can occupy is as a convening body and in capacity development. And what we're doing in the beginning of March, we're going to have a meeting in New York for the 2nd and 3rd, possibly also the 4th of March. Invite the OECD, invite other bodies, IMF included, and have presentations on some of these issues and then dialogues on them. And why is that capacity development? Because a lot of people now are having to advise their ministers on these issues. A lot of them have to be involved in negotiations, and we think we can have a constructive role, paying due respect to the very important starting work and continuing work of the OECD Secretariat, of the Inclusive Framework, but having a dialogue in the UN space, saying, call it's the UN, everyone's equal, businesses respected in the development space, and NGOs are respected. We'll be inviting NGOs. So we think actually you might think that's a bit reactive, but we think that all the air in the room of international tax reform now is sucked out by digitalisation, and it's not really about digitalisation anymore. It's beyond that. So that's what we think as Secretariat the best thing we can do while our tax committee ruminates on the current work, ruminates whether there's something different in the UN context because the UN model is different, but there's so many issues there, and that's why we think we can actually have a constructive role, including helping the OECD, because we've always thought part of our role is where the OECD does something which is good for non-OECD countries. It's actually helpful for the UN to say, hey guys, this is actually good for you too, even though you're not an OECD country now. And that's changed a little bit since the Inclusive Framework, but I think we still have a very important convening role on that, and having a good space where all stakeholders in the system can have a good dialogue on what the issues are and what the alternatives are. what they should be telling their minister and how they should be negotiating.
It reminds me, sorry, very quickly, it reminds me that...
Not another advert, I
No, it's an advert for us all.
Oh,
don't worry.
Then it isn't.
We have something, I mean, it's part of the architecture. We have begun something called the Platform for Collaboration on Tax, which is the UN, OECD, World Bank and IMF working together and trying to get a bit more coherence into our thinking and our collective action, and as a minimum, making sure that we don't give conflicting advice to developing countries. So that's a little bit of the architecture that might be of interest.
Thank you very much. One last question by Joaquin.
Actually, I have two, if you don't mind. Thank you. First question is, Michael, you just said, and I tend to agree, it might be beneficial for many countries to just work on the VAT to get it more neutral and then maybe a lower burden on labour. And so I'm wondering, why then is IMF and others so much pushing for DBCFT? I mean, we all know it's basically equivalent to VAT if you add a payroll to the DBCFT component. And so I'm wondering, is that a concession to fiscal federalism in the US and the EU? Because, in the US, VAT would be something for the states. You might not get it in the EU. To get it more neutral, all 28 have to agree, so you won't get it. So is that the background, or is it maybe a transparency issue? Because if you did the real thing, everybody would see there is no classical corporate income tax left. And that might raise issues, but wouldn't that then nevertheless be better? Because if it's politically not accepted, then maybe we should still have something that taxes on normal returns. So I'm just wondering, what's the background here? And the second question is, I was at a Geneva conference organized by Vienna University, curiously enough, in Geneva, 2 weeks ago, and there the predominant mood in the room, and in the room was, for example, sharing this mood, Jeffrey Owens, was that the proposal now for the unified approach is a little bit of an aberration because it introduces those formulary elements, and we should wait some 10 years and then we will have enough data and artificial intelligence to really get transfer pricing right, and there's no need anymore for formulary apportionment because transfer pricing would be just as simple as the formula would be. And I tended to disagree, and my disagreement was not fundamentally based on questioning this development, I don't know, but I think the fundamental premises underlying transfer pricing that we tax, where the supply side creates value wherever that is no longer really accepted. I mean, the OECD is kind of obscuring this fact a little bit, at least in the official language of the unified approach, but I think the fundamental issue here is whether or not you can fix transfer pricing as a technique. The underlying premise is no longer accepted as a premise for allocating taxing rates, and so I didn't agree. And how do you see that? Do you see this is the issue, or is it really just the technicalities that now lead to formulary approaches?
Should I kick off? Oh, I should get. So, do you want to go?
More about the transfer pricing.
Well, I'll let you.
Sorry for all that.
No, I
That's
think,
not a robot, though.
I think on the first one, I wouldn't say the fund is pushing the DBCFT. We've worked on the DBCFT. We've had working papers, and I've sort of, as far as I can, in my personal capacity, written papers on the DBCFT. But we're not. I think we were quite. The only example I can think of is we did have quite a positive assessment in the US context, but the US context is very different, right? Because there's no VAT, and clearly there, the rationale for the DBCFT is largely that of getting a VAT through the back door. So I wouldn't say we're pushing it. I think we're certainly interested more generally in the destination idea. What, as I was saying, is really it's the border adjustment that's really the critical thing. So we've worked also on the idea of doing a destination-based ACE, which you could also do through border adjustment. So I wouldn't say we're pushing it. I think you could certainly say that I think not just in the corporate tax area, but other areas, that over the last 50 years or whatever, we've encouraged developing countries to adopt corporate tax systems and tax systems more generally that are too complicated. That many advisors have kind of exported systems they knew from their home countries to developing countries. So I think you could certainly make a case that we've probably made a historical mistake in not using cash flow taxes more, I suspect, in low income countries. But beyond that, I wouldn't say we're pushing it. But the arm's length pricing thing I'll leave to Michael, except to it's interesting the point you make. So when I've thought of technology more and where we might be in 10, 15 years, I was thinking more that genuine residence-based taxation, looking through the corporate entity, might then be more feasible as a way. It has its own difficulties, but I suppose 5, 10 years ago we'd have thought that the kind of information exchange we do now on interest and so on would be impossible. So why not 10, 15 years? Why not be able to look through the corporates and be able to dispense with the corporate tax and just do everything at shareholder level? Sorry.
No, I was just going to say that is one of the huge transformations, is the ability of governments to exchange tax information. There's lots of potential there.
Yeah, I agree.
Just on chat, my wife's buzzing me about whether she can escape from Rome. She's there during a general strike. And we were meant to be leaving England during Brexit on the 31st, but we're safe on that. On transfer pricing, I mean, Jeffrey has great faith in the technology. A lot of people talk about blockchain, for example. Blockchain is great and it's important. It's going to play a big role in verification, but it's still garbage in, garbage out to some extent. And transfer pricing rules at the moment, I mean, it still usually results in a range rather than a single outcome. So I'm not sure how robotics and so forth will help that, unless you have an algorithm which is programmed in, which is essentially a formula anyway. So I'm not sure on that. I mean, for myself, we've always thought that an arm's length is a good principle. The principle, if you're dealing with someone who you're close to, look at what your dealing would be with someone who you weren't close to. And that still abides, but now it's so difficult with very complex provisions with a lot of intellectual property involved where there's no market comparator, that you have to have something to do with that. I don't actually mind bolt-ons to a principle, as long as we acknowledge that it's not completely principle-based, as long as you're transparent, as long as you have a good system for determining disputes. And again, the determination of the dispute shouldn't be, it's not enough to say there's certainty of a result. I've always said, Stalin show trials were very certain, but certainty of itself is not good. It has to be the right sort of certainty, and the certainty you want is that the agreement the countries has reached is that cases, that's applied to cases in a way that is coherent and sensible and reflects the deal that they've come to. And that to me is the biggest issue at the moment. Not certainty in itself, because often certainty for taxpayers, less certainty for governments, and as I said, certainty is not a good in itself. But I think arm's length still has a role, but it's just there's more and more cases where it's not really applicable and fictional and so forth, and therefore you have to have some result. But as Mick said, the formulas, in principle, formulas work, but there'll be winners and losers, and of course everyone wants to know whether they're winners and losers to tell the minister.
Thank you very much for that. Now we have just a couple of minutes as a concluding thoughts. I would like to thank you all for this wonderful first Global Tax Symposium. It's been 7 hours of discussion on fundamental questions that we as humanity are dealing with on this planet. And I am delighted to pass on the torch to Eduardo Traversa, who will be holding our second meeting next year in Belgium. Before we move to Asia, where we plan to hold our third meeting in Melbourne in 2 years' time. Eduardo, would you like to say the last few words?
Yeah, it looked more like a global tax marathon. But I'm happy that everyone survived. And
few didn't.
Yeah, I can see that. But I would like to thank all the speakers, all the participants. It has been a great first time, and since there is no second chance to make a first good symposium, as someone said, I think it's a good sign, a good omen for the future. So we'll make sure that we reconvene in Belgium next year, and hopefully that we continue this global exchange, which I think can bring a lot. So not only to senior academics or officials, but also to the younger participant in this room. And I'll make sure that next year the younger participant will have a bigger role and a bigger space. We'll make sure that we have less papers to discuss and more time for discussion on the future with people that will be directly involved in the future of taxation.
Shall we take an official picture of this symposium? And thank you very much.